If you're watching this video, it's probably because you're serious about your trading. And if you're serious about your trading, very likely you've tried to think of how well your performance stacks up against the performance by other traders. If you've gone through that process, very likely you've come across the Sharpe ratio, invented in 1966 by William Forsyth Sharpe, who won the Nobel Prize for his CAPM work and also is famous for the ratio we're discussing today. The Sharpe ratio was first to introduce the notion that risk and reward must be considered together, and it is meaningless to compare returns in isolation without also accounting for the risks incurred. In that sense, the Sharpe ratio is the grandfather to a lot of risk ratio variations and methodological cousins, and it is one of the reasons why it is widely used in assessing performance by investment managers such as funds, hedge funds, exchange traded funds, and so on. The Sharpe ratio works best, i.e. is in its comfort zone, when it is benchmarking low-risk investments that sport homogeneous market exposure, i.e. investments that are either always in the market or have a constant risk profile, as we said before, particularly when there's no big jumps in risk. Unfortunately, financial market trading was really not invented in the way we know it today by 1966, so don't take what I'll say now as a criticism of Mr. Sharpe. But today, a lot of traders trade with very high risk. It is not uncommon for independent traders to trade with values at risk of 20% or more, which means they could be losing more than 20% reasonably often. And there is a systematic bias that favors high-risk situations in that setup because returns are bound to the downside. You cannot lose more than minus 100%, but you can certainly make more than plus 500% if you take a lot of risk. And in that situation, the Sharpe ratio tends to favor, with a bias, high-risk strategies to the detriment of low-risk strategies. So in that sense, it is dangerous to use it in high-risk settings. Of course, it is also dangerous when you're talking about trading activities which have variable activity. So some people have periods where they trade a lot because there are more market opportunities. And when there aren't any market opportunities, they're smart enough to not trade at all. And how do you account for those changes in risk profile? Or even for things like leverage, which wasn't available to the degree we know it today. It could be that a single trading strategy sometimes trades with a leverage of 1-to-1 and sometimes goes up to a leverage of 1-to-100. So how do you compare the risk within strategies and also across strategies in those setups? And really, the Sharpe ratio is used as a tool by many people without really knowing that there are considerations that make it not really suitable to account or to compare performance across trading strategies. And it is really tough. So how do you compare traders that obtain the same Sharpe ratio by swing trading or scalping? We know that the trading styles are completely different, but they could be comparable across performance. How do you really know who did better out of both? Well, we at Darwinex try to implement an apples-to-apples approach, and we follow a different route. On the one hand, we take you and your trading performance, and since it is unique and very hard to compare how you trade with your style and with your risk with other trading strategies, what we do is we come up with 10,000 random monkeys and we put you both to compete in a level playing field where the market exposure for both you and the random monkeys is the same, i.e. you both take the same frequency of trades and the length of your positions is exactly the same. The market conditions that apply to you and the 10,000 monkeys are exactly the same in terms of potential volatility. And the trade-by-trade risk is replicated exactly. So whatever trade you take, the monkeys take with exactly the same deleverage, so that your performance and their performance is completely comparable. To see how this is done in the Darwinex interface, we're now going to have a look at a strategy. Darwinex leverage. So every trade is taken with the same risk both by you and the 10,000 monkeys you're competing with. So, to see this in practice, let's go to one example in our interface. Which is sporting what we call the monkey test versus leverage illusion, which you can find within Darwinia and the performance batch. And let me explain what's going on. You're seeing two curves in here. For the time being, we're going to focus on the blue curve at the top. And what that curve is doing, it is plotting the performance, your performance, against the performance of the 10,000 monkeys across the 100 positions that this particular strategy did in the last 6 months, as you can see here, or you can see here also in the visor. So as we said, there were 100 positions, and this strategy obtained in the 6 months with 100 positions a return of 12.66% and ranked therefore better than, well, worse than 1,239 of the monkeys and better than about 8,761 of them. The best monkey that traded with the exact same conditions and leverage as this strategy obtained a return of 51.63% compared to the 12.66 that this strategy did. The average monkey lost 0.5%, and that's basically how we compare. So the only way to know whether you did well or badly, because it's really hard to find a comparable benchmark, is to compare you with random monkeys that trade with the same conditions as you and see what happened. Now, obviously, there's a catch here. I'm sure you've probably caught it already. And so let's take this to the extreme. Let's say you traded for 99 out of these 100 positions with very, very, very low risk. So say a leverage of 1-to-1. And in the last position, you choose to gamble all out and took a trade with a leverage of 1,000-to-1. Now, obviously, in such an extreme scenario, what would happen would be very driven by the outcome of that last gamble. If you won it, you would look great and beat at least half the monkeys. Obviously, the other half would also win that trade. If you lost it, then you would lose worse. You would look worse than all the other monkeys, which wouldn't necessarily reflect your performance in the 99 previous trades. For that, we introduced the other competition here, which is the green series we're plotting here, which we call the leverage illusion. And what's going on here is exactly the same competition, but here we have our hands tied and the monkeys have their hands tied in terms of leverage. So there's no leverage being taken over here. And that way, the performance on this green line cannot be subject to the same trick we mentioned before, which is basically to take more risk in some trades and get lucky and perhaps look better than you should have looked. So if you have two strategies that are doing similarly well on the monkey test, on the blue line, well, obviously, since we said that that line could be subject to issues, as we just discussed, whichever of the two strategies sports the better on the green series will be the one that gets the higher performance. Now, depending on the rank that you do against the 10,000 monkeys, you will be given a grade in performance, which is displayed here. This strategy is pretty good. And obviously, the further you fall below the average monkey, the worse your performance is. So that's it. To summarize, we benchmark performance across styles and risks so that we can compare on an apples-to-apples basis by basically saying, instead of comparing the strategies directly with each other with some sort of risk-reward ratio, such as the Sharpe ratio, what we do instead is to benchmark both against comparable random monkeys and look at who did better than more random monkeys. And whoever did that gets the higher performance grade in that linear, as you know, from 0 to 10. So if you have any questions, feedback or suggestions, feel free to reach out to me in the details provided here. You can also check out our YouTube channel, which includes more explanations of how DarwinX works, or just visit DarwinX and the glossary, which explains a lot of these concepts in written format. That was it for today. Thank you so much. Take care. Happy trading.